Well, good evening, everybody. We are so excited to have you join us and welcome to the Wealth Builders Real Estate Webinar with Billy Epperhart. On behalf of Billy and Becky, I want to welcome you to this webinar. I'm Karen Conrad, and I have the honor and the privilege of being the Vice President of Wealth Builders. And we are so excited that you have joined us tonight. And I think you're really going to learn a lot from Billy as well as the panelists. We've got a couple of our coaches on tonight. We've got Frank Pulley. Frank, if you want to say hi to everybody.
Hey, everybody. Welcome to the webinar.
And Mike Davis will be joining us in just a few minutes. And I want to give you just a little bit of information on what you can expect, as well as a couple highlights that are going on in Wealth Builders that I think will be of interest to you. So first of all, I want to let you know, if you've not been on one of these webinars before, this is an interactive webinar. And what I mean by that is we reserve time at the end of this session, 15 to 20 minutes, where the panel, Billy, will answer your questions. And so there's a couple ways that you can enter your questions if you're watching us on Facebook. Just go ahead and enter that question in the comment section. And if you are here on Zoom, you can enter your question in on the chat section. We have a great team standing by, Wealth Builders. Thank you so much, team. And they are getting your questions and they're pushing those over to me, and we'll answer as many of those questions as we can. Also, I want to let you know that if you have not already subscribed to Wealth Builders, I encourage you to do so. Go to wealthbuilders.org and you will join our email list. Billy and Becky have so much content out there. Matter of fact, I think Billy has over 1,000 blogs out there on various information that he provides just completely free of charge to you. So when you subscribe, you'll be getting information that's going to help you on your wealth building journey. Also, we have started something called Wealth Builders University. And this is an investment also that Billy and Becky have made in us and in you to help us in our journey of making sense, of making money for making a difference. And you can join for a whole year for just $299. And we have a monthly mastermind call with the speakers. And so I encourage you to learn more about that. You can go to wbuniversity.online. And Billy has a podcast every week. It is power packed with information. It's just about 15 minutes. So go check that out, the Wealth Builders podcast on Spotify. And finally, this weekend, we have got the 2021 October Real Estate Workshop in Denver, Colorado. This is very exciting for us as a team because it's the first time we've been able to be in person for over a year. And you know what? Our in-person has sold out. So we are packed out, but we are live streaming this event. So you can still be a part of that. And to learn more about that, go to wealthbuilders.org. So we are so happy, Billy, to have you on tonight. And I know you are loaded up with information, so I'm going to turn it over to you.
Okay, thank you, Karen. And I just want to say hello to everyone. I'm excited. This is the first time I think I've done a webinar in quite some time, but I'm certainly looking forward to the real estate workshop this weekend that we're having in Denver. And Karen, I think people can still join, can still sign up. You can't sign up for live, that's completely full, but they can sign up for live stream. Is that right?
They sure can. And go to wealthbuilders.org and just click on the banner there at the front. It will take you right to the registration page.
So you can be aware of that. And today I just want to kind of share where I think we are with a couple of areas. I'll talk for just a minute here in the beginning about the stock market in general, and then we'll talk a little bit about cryptocurrency. I have a few comments I want to make there. And then also I'm going to talk about housing in general, real estate in general, and rental real estate specifically here as we kind of talk about that. So those are going to be the general areas. And then if I have time, I want to talk a little more about some things that I have covered the topics, but I've never covered the specific information that I want to today on the different kinds of bubbles I think that are potentially out there. And we'll kind of look and talk about what those are and how we can recognize things. So first of all, let me just say to all of you again, welcome. I appreciate you joining us. And if we talk about where we are right now, economically, really just across the board, one of the things I said recently on one of the deals I did in the last couple of days, I can't remember where I was or who I was talking to, but right now I've been talking about this for about 6 months. I think we are facing a correction in the stock market itself and in paper assets in general, and that would include bonds as well. I think we're facing some challenges, and I think the stock market itself is headed for, some people are saying, a 60% correction, which would be monumental. That would be a massive correction in the stock market. I think realistically, we're probably looking at a 20 to 30% correction in the market. And the reason a lot of times when I'm talking about the economy, I start off talking about real estate and not gold I start off talking about the stock market, not real estate or gold or some other form when we talk about cryptocurrency here in a few minutes. And the reason is because the stock market typically is, in my opinion, it's the best kind of temperature gauge for where things really are, so that when paper assets start failing, it can and has the potential to back into all of the different aspects of the economy itself. And so briefly, I just want to say, I think we're looking at that, and I think that's coming. That's why people who reach out to us, Karen, for information and things, I think they need to make sure their paper assets, that they are doing what I'm calling hedging or protecting themselves in the area of their paper assets in the stock market itself. Now, I'll talk about cryptocurrency for a second and what I call digital currency. And really, cryptocurrency is in the same place right now, in my opinion, that we were with the internet in 1999 and in 2000. And most of you can remember that in 2000, who are old enough to remember that we actually went through what we called then the internet bubble. And the term was the internet bubble. We had a crash in March of 2000 where there was a lot of things that were being speculated. So let's talk about that right now for just briefly in the context of cryptocurrency. I think, some of you may have heard this past week that the government has come out and said that they want to begin to regulate digital currency and regulate cryptocurrency. And they also had made this statement, and this is a massive statement when it comes to economic things, and especially cryptocurrency, that they want to tie cryptocurrency to actually hard assets. And a lot of people, they ask the question, well, what does that mean? Well, if you go back and look in the history of our economy, you'll see that up until really the 1960s or so, our actual paper money, so the dollar bill, was connected to a hard asset, gold. And then we went off the gold standard. We had what was called gold certificates. So if a $20 bill was printed, or a $1 bill was printed, or a $100 bill was printed, it said right on it, gold certificate. And that actually meant that paper money could be redeemed for that much gold. That's what that meant. And then later we went to more of a silver standard, and we have what was called silver certificates. Today, we don't call our money, you don't see printed on the modern dollar bills. You don't see gold certificate or silver certificate printed. And what you actually see there, or understand in what's being said about our currency, is that it's actually, they call it fiat currency. It means that it's not really tied to a specific hard asset, but what it is that it is supported by the general economy of the country and by, for example, the gross domestic product of the United States. And just, in other words, the economic engine of the United States is supporting those dollar bills. But if you went in to try to redeem them for some hard currency, if the value of currency went way down, you couldn't do that anymore. Now, the reason I'm bringing that up and covering that in the light of cryptocurrency is that's what we have today with cryptocurrency. Now, I want to talk about two aspects of cryptocurrency. Now, the first aspect is how is cryptocurrency actually being traded, in the sense of what does it represent economically to us? And right now, cryptocurrency has grown from the point of just being some kind of new creative thing that's out there that people could take risk on, to now cryptocurrencies actually being traded as a commodity. And that means that, and the best way to think of a commodity is what I just used a minute ago, which gold is a commodity, right? Silver is a commodity. And so it's being traded more or less today, value wise, in the sense of how people look at it, because it's not producing anything per se. Say like a real estate, for example, a piece of rental real estate would produce rental income. It's not producing anything, but people are trading it and exchanging it like a commodity. But the piece that I want you to know is that if the government goes to the next step and they actually start connecting it to some kind of hard currency, the first aspect is it definitely will, in my opinion, make crypto go down in a hurry. And then crypto as a commodity, if that happens, will no longer really exist, because it'll be connected to whatever hard asset is backing it up. So you have to be concerned or watch what the effect of that is going to be. However, let me say this on the other side of cryptocurrency. I believe that cryptocurrency and digital currency is here to stay, just like the internet was here to stay in 1999 when it began to come in. We went through the internet bubble of 2000. And of course, today, what we're doing on this Zoom is, of course, built, is in the internet, right? We're actually communicating through the internet. So I believe that cryptocurrency is here to stay. So if you're going to invest in cryptocurrency, I like to say it this way: you need to invest with what I call your fun money. Some people I know personally have invested some of their serious money, and I have invested in cryptocurrency too, both directly and indirectly. So, and we'll do a whole webinar on how all the different ways that you can invest. But in this day and age, right now, while I'm talking, you actually can invest directly in digital currencies like Bitcoin or like Ethereum, and then like Dogecoin, all kinds of different ones that are out there, even ones that are coming on that are worth 2 cents. I mean, there's all kinds that are out there, or something like Bitcoin you have that's running around $50,000. So there's ways to invest, but there's also ways that you can invest that are not necessarily, say, directly in a specific digital currency. And one way you can do it is through, of course, exchange traded funds that are on there now. And you're able to go, it means ETF. You can actually get exposure to digital currency through an ETF, or you can get exposure through some of the different cryptocurrencies by simply buying some of the exchanges that are out there. Like Kraken is one of them. And there's several others. There's 4 or 5 bigger ones that are out there that you can do. But here's what I want to say, because if I have time, I'm going to come back and talk about bubbles. One of the things that you have to realize right now about cryptocurrency, it's very difficult to find any inherent, what we call intrinsic economic value inside of cryptocurrency. It looks more and acts more, not just like a commodity, but more like a commodity that's in a bubble. And the reason I'm saying that and kind of explaining that to you is that if you invest in cryptocurrency, whether it's directly or indirectly, you have to be prepared for incredible, wild fluctuations in value that come or go. Now, we'll make a little bit of an exception here, and that is because things like exchange traded funds are now being set up for cryptocurrency, and we're seeing larger financial institutions actually investing in cryptocurrency. Because of that, it has become a little bit more liquid, and it's also become a little bit more valuable in the sense that there's actual money out there, big money that's following it, which will typically hold up its value. But right now, I wouldn't put any of my real money in cryptocurrency. I do have some invested. I do have about 6 figures invested in crypto right now, but that's money I can afford to lose. So that's why that I'm doing that. Now let's talk about, so the stock market, when I look at it and kind of where we are, if you take where the stock market is trading today, and you just look at this, at the simple valuation of the stock market, what we call price to earnings. That means what is a stock selling for what it's earning? It's fluctuating right now between 40 and 50 times what we call the P&E, or the price to earnings. Historically, if you've listened to me much, you know that the stock market has traded about 15 times earnings. Now, a lot of people will say, hey, we're in a different time, we're in a different age, the stock market is trading differently. Believe me, all things eventually come back to their intrinsic value. So the point is, you know, we call that value investing. You understand that you're really looking to purchase things that are worth close to what their historical averages have been. And so the market has been real overheated, since it's like that thermometer I talk about in the economy. If it were to go into a correction of 20 to 30%, then it probably would affect a lot of things, including real estate being able to sell. It would slow down the sale of real estate. Now, I don't know how long I've been talking here, Karen. I think I'm okay.
You're great. You've only talked 20 minutes so far.
Okay, so let me talk about real estate for a minute. So where we are with real estate is all of these are connected. And so one way to think about them is, okay, in one category, you have paper assets. And then in another category, you have what I like to call hard assets, which are the commodities that we're talking about, which real estate, by the way, would be included in what we would call hard assets. Then we have other kinds of assets that are out there outside of real estate, such as the commodity assets. And then I'm not going to get into this much, but then we have basically economic assets or debt assets that also can get in the bubble. So what's happening right now is stock market has been so overvalued. Real estate itself, if you notice, this is the first time since 2006 that we have seen real inflation in rents. As a matter of fact, if you look at what you can get for rents now compared, I had some friends of mine, I don't know, they may be tuned in tonight to the webinar, but I have some friends of mine that I'm fairly close to, and they sold their house here just in the last 45 days. And they made a ton of money because they bought at the bottom. They bought this property, I think, in 2012, and they just sold it here in 2021. And so they had an 8-year period. They bought this house. It needed to be completely, really renovated. They did a phenomenal job. And if I remember right, again, and my children, my son did the same thing, but I'm not talking about him now. I'm talking about somebody else. And if I remember right, they paid like $250,000 for the house, which would include the money they put in it to renovate. So that included their renovation cost and the cost of the house. They just sold it for $675,000 because of the appreciation that had come just in those 8 years. But here's where I'm going with this story. So they went to go rent an apartment after they sold their house. I couldn't believe this, but it's true. And they had to sign a 7-month rental, and they had to pay $2,000 a month for a 1-bedroom, 1 bath, just a normal part of town, nothing nice or great, but it just shows you how much rent itself has gone up. That same apartment, in fact, I'm familiar with that apartment complex because it's not too far from my personal home. And I know that, and my daughter had lived in that apartment complex, and we rented a 2-bedroom. I remember a 2-bedroom, 2-bath for her for $1,200 a month. Now in that same apartment complex, it's a 1-bedroom, 1-bath for $2,000 a month. So here's what's happening. Let me kind of land that plane for you. What's happening is rental prices are going up, and because of inflation primarily. One of the things about rents that are positive is that unless we get in an absolute deflationary period, and that is very rare, very, very, very rare, such as what we ran into after the Great Depression in 1929, the deflationary periods are very, very, very rare. So I'm convinced that rental income in the US is going to stay up. And the reason I want to emphasize that is because I'm not necessarily as confident that the actual prices of homes are going to necessarily stay up or continue to trend up. I just read today, getting ready for the webinar, which the best projection for 2022 is that we'll see generally across the board like a 3% increase in home values, whereas just this last year alone, we've been, depending on what part of the country you're in, but we've been between a 15 to, some of them as high as 30% actual price increases in housing itself. Now, I'm going to tell you that trend cannot continue. But what will continue and what will hold up is rental prices. Now, why does that matter? That matters for investors in real estate. So one of the keys, and I'll talk about this at the real estate workshop, that one of the keys that you have to be aware of is whenever you're looking, and I'm not going to give the ratios today, but I'm going to talk about generalities for a minute. And generally speaking, real estate today can still be bought as long as your rental income covers what we teach you it needs to cover. And so if it does, and rents right now are getting so strong that they're almost the price to earnings in real estate, not just stock market, but in real estate, in some areas, some communities out there, some states, actually the price to earnings from rent compared to the cost of the real estate is actually very good. And so people are concerned that, hey, we're way overpriced in real estate. I think we are too. I think some of the stuff I see is crazy. However, if the rental prices go to support it, then it's telling you that that property has that value. And I'm convinced that rental prices are going to hold up. So even if prices in real estate itself get soft. Now, Karen, I was going to do some things on bubbles, and I've had some brand new stuff I was going to cover here, but I think I've been talking
just 24 minutes. You have plenty of time.
Okay. So let me just give you a couple of things. I've done this on some of the blogs, but this is brand new information. I've never given this information in any setting before. Today would be the first time. And so I just want to talk about a little bit because of where we are with cryptocurrency, where we are right now with real estate. And I want to talk for a minute about how these kind of bubble things work and kind of the cycles of what it looks like. Now, some of you, if you've listened to me very long, I talk about, the tulip mania that happened, of course, in Holland back in the 1700s. And again, I want to talk about intrinsic value for a minute, because when people get it in their mind that something is worth something, whether it actually has any real intrinsic value or not, then money starts chasing a particular type of asset. So in this case, in Holland, it was these tulip bulbs, and they began to say, and some of those tulip bulbs became rare, right? Certain kinds. And so people began to assign a value to that bulb when that, for example, that bulb did not produce any rental income. It didn't produce any kind of commodity like corn growing out of the ground that could be sold for somebody to eat. It was just a speculative investment that people, through their money, assigned a value to it. And it went crazy over a period of about 18 months. And then when people recognized that, hey, people were trading their whole livelihood, they're putting everything they had up against it, and it came crashing down. When it did, they came back to what I would call what their mean value had been for the entire time. Historically, it came back down to that, and many people lost their fortunes. Now, here's what happens, and I'm saying this now, I'm going to give these next couple of things to you in the light of kind of where we are in certain areas. I think the stock market's overheated. Right now, I think digital currency has no idea. Crypto has no idea right now where real values are. It's totally speculative. Doesn't mean I hadn't invested in some. I just hadn't invested money I can't afford to lose. So just so we're clear here when we talk about that. Now, so here's what happens, and I'll use the internet bubble of 2000 to give you these 5 stages here quickly. What happens first is there becomes an interruption that happens when something new and truly innovative in most cases comes into the market. So we saw in 2000 the internet, 1999, 1998, 99. Some of you remember you dialed up and it went zzz, or however the noise was, that happened, and then it would connect, and everything was, compared to today, was so slow, you couldn't even download a picture. Right now we're on here talking live. It's kind of crazy. But back then it was a real interruption, in the sense of it was innovative. It was an interrupter into the current business patterns and way things were done. And so because of that, people began to assign a value to certain things. So for example, they would invest in any internet company just because it was an internet company. Whether it had any real earnings or any real value at all, they would do it. And so I did. I invested in a company during that time called Exodus Communications, if you go back and look at it. And I remember at the time I paid $125 a share. I held on to Exodus Communications and it came down to zero. Yes, it did. It actually, the company dissolved and it went from 125 a share down to zero. And so everybody was talking about how Exodus Communications was going to grow and go crazy. So what happens is there becomes where people begin to invest in a certain thing. Think of cryptocurrency now. Begin to invest in a certain thing. There becomes an interruption in the normal way of people doing things. Like, for example, digital currency is definitely an interruption right now. But then what happens is in that there's a displacement that happens, and people take money from one thing and start putting in another thing. And so value starts increasing because money is chasing that particular asset, whether we're talking about companies with the internet or we're talking about digital currency. But then what happens, it gets into a boom. So the first one is displacement or interruption. The second one is it actually gets into a boom where it starts taking off, and many more people begin to realize what's going on. And so they start putting money aggressively in it. Right now, digital currency is in the boom stage. That's where it's at, where crypto is. But then the next thing that happens, and I think we're getting borderline here, we're not there yet with crypto, but it gets to what I call a euphoria stage. It gets to a point where everybody, remember back during the stock market bubble in 1929, the stories about the shoe shine guys giving stock advice, right, of what they were hearing. That's what I mean by the euphoria kind of stage that happens. And so those are the first three, right? So you have what I call displacement or interruption. Then you have actually a boom that happens. Then you have euphoria that takes place. And I'm saying this tonight, Karen, in the light of cryptocurrency. But then what you have is you have profit taking. And what happens is smart money will start taking profits at the top of the euphoria. It starts taking that money or starts cashing in. We've already seen crypto go through almost these first four cycles where it's gone up and down, and there's been such wild swings that's there. But what happens is when that smart money, what I call the profit taking of smart money happens, then there begins to be a panic that sets in. And a lot of times the panic itself overreaches. In other words, it goes so far down that last stage becomes a panic of selling, and it actually goes below what its intrinsic value is, typically speaking. Now, why am I taking the time to talk about that tonight on the webinar? Because right now, I believe we're in a season where you have to think in terms of hard assets. And I think you have to think in terms of hard assets from a traditional value perspective. And so you look back, and one of those is commodities, precious metals. Other one is real estate. You start looking at hard assets, and real estate is always safe as long as the income from investment real estate is in the right ratios to what you paid for, what your principal, interest, tax, insurance is costing you monthly. As long as that is in balance, then you don't necessarily have to be overly concerned about whether that individual piece of real estate has gone up or down, as long as you have the income from that holding up. And I believe that we're in a stage right now where that's going to happen. Right now, as a matter of fact, let me just say this, and I got to quit. Inventories right now, what's available, we only had Realtor.com only had 600,000 homes listed for sale across the entire United States just a month or so ago. So right now, inventory is so low that even with some of the properties that are currently in the mortgage forbearance program that are in there, some of those are going to come back on the market because they're taking away that forbearance program. Even with those, the amount of properties there are, even with some of those coming back on, it's you're still not going to have anywhere close to too much inventory. So until we get back to about 3 months inventory, I wouldn't even be concerned about in any way the fluctuation of where real estate is, even if it goes up or down. So I've talked for a while, Karen, so
You
I'm gonna
have,
land the plane.
it's so much good information. I'm going to just come back to you with a couple questions or points of clarity, because I think with real estate, like what you just described, and when we look at a 50-year history, which you've shown on webinars, it is like a straight up angle for rental history. But what you see with values of properties is it goes up. It might go down a little, back up, but it still is going up. But one of the best pieces of advice, Billy, that you gave me personally, and I think would be good to share, is to watch that cash flow, because that is what mitigates you from being able to not panic when the values might go up and down. And this is something you're going to be sharing at length in the workshop. So can you just comment on that and a couple of the other ratios that we're going to be talking about to help hedge and mitigate that risk?
Yeah. So one of the things, of course, I'm gonna give a updated history of where real estate is and show the graphs. I didn't do that tonight on the webinar, but one of the things that you always want to make sure you're doing whenever you buy a piece of real estate is what we call positive cash flow. So you have to make sure that after you pay your principal, interest, taxes, and insurance, we like to see you have at least a $300 cash flow, positive cash flow. And that's up to a property of about, maybe as high as 300,000. If you're getting up a little above that and you're buying $500,000 properties, then, you basically think in terms of 1%. So I'd like to see you at about $500 positive cash flow if possible. So one of the ratios that we give you are that you're looking for that really 1.2% to 1.5% in rental income. And some people who've been around real estate a long time, they call it the 1% rule, the gross rent rule, which means that if you purchase $100,000 house, you want that house to at least rent for $1,000, or you want it to go as high as $1,500. Now, the truth is because interest rates are still so low right now, which, by the way, I didn't talk about it tonight, but that's what's pushed prices up, has been you've got such cheap money in the market. So right now, it's amazing. In fact, I think I'm going to borrow some money. And I've been saying it for about 6 months, but Becky told me this morning, we have a couple of properties. She said, just go ahead and refinance them and go ahead and take the money. It's so cheap, we might as well do it. So I'm going to do it on a couple of them. But anyway, the point is, as long as you're getting that positive cash flow, and here's where I was going, you can today, Karen, do 1% simply because interest rates are so low. Mm-hmm. Whereas if rates get up to as high as 6 or 7% on mortgage rates, then you're going to have to get back up into that 1.2, 1.3, 1.5%, which means that $100,000 house will need to rent for $1,500, for example. So that's the kind of where you are, and that's what protects you. So right now, if you're locking in those low interest rates, and Mike and Frank may want to comment too, but if you lock in those low interest rates, you can actually in most cases, you can actually operate by the 1% rule and still have enough positive cash flow.
Yeah, that's really good. And Frank, I'm going to call on you to comment on that. You know, being in banking for 25 years and watching rates for a few decades, we can tell you that 6 and 7% is more normal. What we're seeing today is abnormal. In that law of leverage is such an opportunity. So, Frank, let's toss it over to you to comment on this.
Well, I mean, Bill, you're probably with me. I remember when rates were like 15 or 16%.
Yeah,
You remember
1980.
that?
Yeah, 1980.
I know, and I refied my house down to 10%, and boy, was I happy.
Yeah.
And down to 8%, and that was wow. That was
Oh yeah, that was heaven.
So, I mean, those of you that are a bit younger, you know what? We still made money in those markets. You
That's
just
correct.
have to do it a little bit differently. But right now, the interest rates are so low, and you can lock those in for 30 years. It's cheap money.
Cheap.
It's really a great way to hedge your bet, because real estate has made more millionaires in the United States than any other vehicle of investing. And it traditionally has its highs and lows, but it's made about 6% per year for the last 50 or 60 years. So
That's correct.
It's a great vehicle for investment. Safe.
That's great, Frank. Thank you. And Mike, I'm going to call on you next. Mike has really got quite a story. He started investing in Pueblo. Many of you on, I can see are from Colorado. You're familiar with that. But there's still great deals to be had in Pueblo. But let me tell you, when Mike Davis purchased in Pueblo and Billy encouraged him to do so, where it's at today is absolutely incredible. So, Mike, maybe share with us a little bit about your journey. And if you could comment too, I mean, I think a lot of people are wondering, should we do a cash out refi?
Well, the great thing about when Billy got me involved in real estate, Pueblo has been flatline forever. The appreciation of homes here has just been flatline. And Billy said, hey, you can get the cash flow. So just do the cash flow and be concerned about the cash flow. And so I was excited. I was getting, close to $500 a month cash flow. And my $45,000 house today is worth $200,000.
Amazing.
So that's just, yeah. So it's not the $300,000 house Billy was talking about, but I'm pretty excited about my $45,000 house being $200,000. But yeah, can you say hallelujah to that?
Hallelujah.
But I never expected the appreciation, and whoa, lo and behold, it's just jumped through the stars. But that's a God deal, and I'm thankful for that. And what Karen was talking about, I started off because I did not have any money. Well, I said that I had $5,000. I don't want to lie, but as far as $5,000, I thought there's no way you can buy property for $5,000. And that's when Billy said, well, how much do you owe in your house? And I said, well, in 2 years, it's going to be paid for. He says, oh, my goodness, you can do this with that. Because I was talking about a friend of mine, him and I going in together. And Billy says, Mike, you don't need anybody. You can do this if you got that much equity in your home. And lo and behold, that's what I did. I took out money out of my home and I started buying real estate. And it's been a blessing ever since.
Mm.
Yeah, that's amazing. And you didn't depend on the appreciation. It was such a blessing, just kind of on top of things. But also, I think there's a lot of people that are hesitant to get in. It seems like, oh my goodness, should I actually get in the game? And Mike, I think at the time, even though it was a $45,000 house, you had some of those same like, oh, should I do this? Can you just speak on that for a moment?
Well, yes. Well, my wife was very concerned. Obviously, our house is going to be paid for in 2 years. And, that's what everybody strives to get your home paid for. But, I started thinking, and Billy even said this, your home is not going to make you any money once it's even paid for. And so that made me start thinking differently. And I think that's when it comes to an investor, you have to have a different mindset. And just like Billy said, he's thinking about borrowing some more money just because it's cheap. And, when you start thinking about, I just did a refi on some of my property at 2.6%. Wow. That is so cheap money.
Oh, yeah.
But, it's just great because now all of a sudden, like you said, Karen, you're locked in for 30 years and the rates continually climb up little by little. But guess what? Your mortgage payment's going to stay the same for 30 years. And Billy didn't, like you said, he didn't go into the grass, but for the last almost 75 years, rents have constantly been going up and you get 5 to 6% appreciation on your real estate. And so you talk about safety nets that Billy teaches in the work place, or the, what do you call it, conferences, the real estate conference. Man, there's just safety nets that protects you. And I know Billy's an expert in the stock market, but let's be honest, there's a lot of speculation in that. But when it comes to real estate, boy, having a 75-year track record, that's just phenomenal. That's just phenomenal. So I'm thankful that Billy has showed us and taught us these safety nets, and so that you're always safe when you purchase real estate.
Yeah, that's awesome. And some people have been joining us as we're going here. So I just want to mention again, we do have the real estate workshop this weekend. And while we're sold out in person, we have got a live stream available for you. And with that, you actually get to keep that recording to view it for 3 weeks. You'll be involved in the Q&A, so it's a really great experience. So I'm just going to ask the Wealth Builders team if you wouldn't mind just posting that URL in the chat, so that if people want to go ahead and register for the live stream, that they can just click on it and go to it. Mike, I'm just going to comment on one thing you said, and then we're going to get to some questions. We've got some great questions coming in. There's one thing you said, that you took the money out of your house and you used it to invest in real estate. You didn't go out and buy, a depreciating asset or go on a big vacation. And I think that's really key. Like to create wealth, according to Deuteronomy 8:18, we use the law of leverage to create more wealth. And I thought that was just really awesome that you mentioned that, Mike. Thank you. All right. Well, Billy, we've got some questions coming in, and I just want to let you know you've got a lot of people on tonight from all over the United States and all over the world. We've got people on from Colombia, Washington State, and I'm sure there's many more on here too. So we just want to welcome everyone and thank you for joining us. All right. Are you ready, Billy, for your first question?
Well, I think I am.
All right. This is coming in from Pamela Oxford. And thank you, Pamela, for joining us. And she said, if you only have $1,000 to $5,000 to invest right now, where would you recommend investing it? Also, what are your thoughts on a multi-level marketing business that is run by a believer?
Well, first of all, if you have $1,000 to $5,000, I get that question a lot. And right now, the traditional answer I always give is you start investing in yourself. Learn to invest in yourself at a level where you learn and develop the knowledge and understanding that we teach on the laws of wealth. And honestly, what was it, Pamela, that asked that question?
Yes.
So Pamela, that's honestly how I started. I started by investing in myself. And honestly, truthfully, that's the reason we started Wealth Builders. We started Wealth Builders in order to help people understand and know how to build wealth. So let's talk about the second part of the question on multi-level business. One of the things is I like multi-level businesses in the sense that I think they create a growth environment for people to develop and grow in. Also, secondly, they can also create a great stream of income, especially if you get in the right one and you work it properly. The issue that you need to know about multi-levels is typically, I would say 98% of the time in a multi-level, you don't actually have a business that you can sell. Now, I'll get some comments back on that and some emails that say you can, but in the traditional sense, it's not like it becomes a business that you can value. And so you can actually do research on the internet to see what kind of businesses, for example, have what we call the strongest multiples. In other words, you build a business with a certain level of income, and how many times either what we call top line income that you can sell that business for. So that's the downside when it comes to actual assets, because we've been talking about assets tonight. Typically, a multi-level business is not something you would sell or could sell to the general public. I know people who've done it. I know people who've stepped in, but it's just not one of those kinds. So I think that's the difference. However, it can become a good source of income, but it's not necessarily a good asset.
That's great, Billy. Thank you. And I'm going to stay back on the real estate track. Mike, I'm going to send this your way because it's kind of a follow-up question to what you were talking about. Ava is asking, and hello, Ava, thanks for joining us. Is it a must to first have your house paid off before investing in real estate? Can you comment on that?
No, like I said, I owe just 2 years, but if you have a lot of equity in your home, you can take some of that equity out. And most mom and pop banks, Karen, you can comment on this as well, that you can get up to 80 to 90% of that equity and pull it out to invest in. So no, you do not have to have your house paid off. You just have to have equity. And of course, nationwide, I think people's homes have equity in them because just about every market in the United States have gotten some appreciation. So she should, and listen, when I was doing the refi, I was checking like, I thought, well, I feel like I knew how much my home was worth. And lo and behold, every month that I started checking, it was escalating, going up in appreciation. So I would jump on you. It's not going to give you an exact, but you can go to realtor.com, Zillow.com, and some of the homes in your area that are for sale, you'll be shocked about how much appreciation is in your home.
Yeah, go ahead.
Yeah, Karen, one thing I want to say is that when Mike used a home equity loan to buy that first $45,000 home, which he has several now, but when he bought that first one thing you have to remember with this appreciation market we've been in since about 2012, with real estate going up, you have to remember if you had one home, meaning your personal home, and you decided not to buy the $45,000 house, you're going to get here's what people need to understand. You're going to get the same appreciation on your home, that one home you have, whether you took a home equity line of credit or not, or you did a second mortgage, or you just completely refied. Whatever it was, the point is that house is going up. So now Mike has his home that's gone up and appreciated like crazy. Plus the $45,000 house has grown to $200,000. Now, if you take that exact same level of appreciation, and just as an example, I'm only using an example, let's say you were to extrapolate that out to 10 homes. So you've got $160,000 of appreciation that came in one $45,000 house. For example, if it's at 200, you do that times 10, that's $1.6 million. All of a sudden you have become a millionaire in your equity in your home. And that's the kind of thing that people who have a very limited mindset miss it. And honestly, the first wealth I ever built came exactly the way that Mike explained it. And the truth is, now later, I take a little different approach, but for people that are just getting started, that's exactly the way you do it.
That's so good, Billy. Thank you so much. All right, I'm going to go to Frank on this one, and then Billy, I'd like you to jump in after Frank to comment on this. This is a great question. This is from Kevin Rains. Hi, Kevin. Thanks for joining us. And we hear this a lot as well. He says, with the housing market where it is, should you buy your first home now or wait for the market to correct? Going to you first, Frank.
All right. Thank you for asking that question. And, I don't think real estate's going to get any cheaper. But where you can maybe find deals is some of the outlying areas, maybe not in the big city, but still a commutable distance away from where you work. And that's exactly what happened with Mike. People from Denver and Colorado Springs couldn't afford the housing there. And so they commuted down to Pueblo. They bought homes down there and it increased the demand. So now Mike's sitting where he's at, but there are still outlying areas from all of these cities that you can get a good deal on a house. I think buying sooner rather than later is a good idea. Now I'm talking personal residence. If you're an investor, once again, if you're knowledgeable on what the numbers should be, and if they line up with some of the formulas that we teach, it's really hard to go wrong.
That's great, Frank. Billy, can you comment on that? I think you probably get asked that a lot from people as well.
Yeah, I think, again, what we talked about in the beginning when we started questions and answers here is that right now there's such cheap money in the market that you look at what it's going to cost you that you have to pay in rent, especially, for example, if you're actually renting a house. And with as much as rents have gone up compared to what you can actually get a loan for, typically speaking, for most people, the balance of that ratio between what you're paying in rent and what you can actually borrow money for to buy your personal home, then it just makes sense to buy your house. And so I think the home you're going to live in. And anybody who ever asked me this question, even outside of the current market that we're in now, that is definitely overheated because of cheap money, I always tell them the same thing. If you want to be a real estate investor, always invest in a home for yourself first. And if you'll do that, then you have the equity that you can deal with and play with, like Mike has given such a good illustration tonight about how that works. So I do think the market, once the stock market corrects, I think the actual price of housing will soften up. I think that what we're going to see, there's going to be some uncertainty in the market, but I'm going to tell you right now, rents are not going to soften up. Rents are going to continue to tick up. And so I think right now, if you look, I think it was Kevin that asked the question. I would rather you look. Now, if you're somewhere like Woodland Park, Colorado, which Kevin may be in, I'm not sure. But if you're out, Frank said something just a second ago that's really important, that you can start looking outside of the immediate metro areas and start looking at we always teach that in the workshop, that you go to those circles that are right outside, and usually those homes are a lot cheaper. Plus, let me just make this comment quickly. If you're in, for example, let's say the mountains, I'm sitting here right now in Woodland Park, Colorado, looking at Pikes Peak right there out of my office. But one of the things that has happened is you can find housing where you're actually fixing a problem. Now, let me give an example in the mountains of what I mean. There are cabins and things that are up here in the mountains with these prices as crazy as they are, that actually have water problems. And so if you can figure out how to solve the water problems in some of these cabins, it's amazing what you can buy those for. If Kevin is in the Dallas area, which I think I just saw, if he's in the Dallas area, those small communities out around, I know you guys, Karen, if you want to say that, are investing out in, I think it's called McGregor, which is out below Waco, but you can look outside of the metro area and still find some really, really good deals that honestly meet the rent ratios very cleanly. And so, Kevin, believe me, they're out there. And Texas is a great place to do it. The only thing you got to watch in Texas, make sure you're factoring your property taxes at a level that they need to be factored in, because they're quite high. But as long as your ratios, meaning how much you're bringing in rent compared to what your principal, interest, taxes, and insurance are, then you're going to be covered. So just looking outside the city.
That's really good. And we live in the Dallas area, and we're definitely looking to go out a bit. But even in the immediate suburbs where you could commute to work, there's still some good deals to be had. And the growth patterns, you can see where those growth patterns are. That's what Billy teaches us. Watch those growth patterns and buy out ahead of it. But something just hit me while you guys were talking, is that, hey, if somebody wants to actually stabilize their rent or their housing payment into the future for 30 years. Imagine the difference between locking in at a mortgage for 30 years and experiencing that steep increase in rent. You sold me right there, Billy. If I didn't own a home, I'd be out buying one right now.
Oh yeah, there's no comparison.
Yeah.
Because your rents are going to tick up, and that payment's going to stay the same for 30 years at cheap money. I'm telling you, at some point here in the not too distant future, interest rates have to start equalizing.
Yeah, that's so good. All right. There's so many good questions, you guys. If you can hang on just a few minutes after the hour, I just have 2 questions I want to present that are very good. And then I've got some questions coming up about the conference. So this one, Billy, I'm going to come back to you on this one. This is from Sandra Keller. Hi, Sandra. Thanks for joining us. And there's so much buzz around this topic, which is why I want us to talk about it. If a tenant in an investment property cannot pay rent, how are COVID rental moratoriums affecting landlords? And she knows that this may be variable state by state, but this is really something that I think people are kind of afraid of. But what are the actual facts on these moratoriums?
Well, most of the moratoriums have now been lifted. And I know the last, even the mortgage forbearance moratoriums are now being lifted as well, because businesses, banks and businesses in general that are built around real estate can't function. And so they're basically driving people out of business. So right now, I think the bigger question is not so much on the rental forbearance as much as it is you just need to be careful if you're going to be buying property as a piece of rental investment property. You just need to make sure that if you're thinking about the Airbnb or you're thinking about VRBO or something like that to do short-term rentals, you have to be aware that there can be some challenges there with your cities, your municipalities, your homeowners associations, et cetera. So as long as you're being smart there. But right now, Karen, to be honest, I don't know of any current areas, unless maybe you're in the heart of New York City, where there's actually any rent control, direct rent control that's going on. I think most of that has been lifted.
Yeah, I think so too. And, it definitely does depend somewhat on some states, but it's been lifted. And, we've got a really seasoned speaker and coaching group. Bill Bronchek is going to be joining us this weekend. Dan Dyer. I mean, these guys have got a lot of properties. And we asked the question, like, hey, how is this affecting you? And the percentage, Frank, tell me with Bill, he owns hundreds of properties. And did you say, like, what percent is paying perfectly on time?
I think he's only had a couple percent of people that have not paid. And I know there's some landlords that have experienced worse than that, but honestly, most landlords have been pretty pleasantly surprised at how people have stepped up and paid their rent.
Yeah, and I know in Texas, there's a state program available. There's a lot of steps you go through before you actually hit that point. There's been a lot of noise in the news about this, but that's where with this group, we're going to get to the facts for you and give you some good information. Okay, B is asking the question, and this is having to do with the conference this weekend. Regarding the virtual attendance for this weekend's conference, will the sessions be recorded and available for replay? If so, how long? And so, yes, the sessions will be recorded and they will be available for replay for at least 3 weeks after the conference. And then she did see that there's been a discount, but we're through all the discounts, at this point, so close to the conference. But I'll tell you what, your investment in this conference will be well worth it, and you'll have plenty of time to review those sessions. All right, one final question here, and we're going to have to quit. This went so fast. And this is Fred. Fred, great question. And Billy, his question is, what about gold? He saw that it just went up to $31 an ounce today.
No, not gold. Gold. I can pull it up real quick, but gold is a lot. If he's talking about 31 an ounce, gold's running around 1780. I have to pull it up here on my app. But it's a lot higher. Now, silver, to the best I know, let me pull it up to answer the question. Where did my app go? I have all my precious metals. Here it is. So gold is at 17.99 an ounce and silver's at 23.18. So I'm not sure what he was looking at on the $31. But let me just reset that. Yeah, because I knew the 17, wasn't sure about the silver. So so gold's 18, silver. If I was investing right now, even though I've bought some gold, I still like the gold to silver ratio, so that right now silver is actually cheaper ratio wise than gold is from a historical perspective. So the ratio compared, and so silver is at a really good price right now. By the way, I still like gold, just so we're crystal clear, but the ratio price favors silver.
That's great. And Fred just clarified it went up that amount today.
Yeah, maybe went up and came down.
Yeah,
Yeah,
exactly.
but it ended today at 23, 20. I think it stopped at 23.18.
Wow. Okay, great. And I do want to let everybody know we'll share more about this weekend, but we have an investment conference coming up as well in December, that first weekend. And if you go to the website, that event is up and going. And we'll introduce that to you all this weekend, but we'll be covering the topics like this in depth at that conference. So we are very excited about this weekend. Billy, thank you so much, Frank and Mike. This has just been awesome to have you guys on. I know people are really blessed. And I want to thank all of you for joining us. We just love doing these webinars and helping you to really make sense of making money from making a difference. Again, there's still time to register this weekend. Go to wealthbuilders.org. We would love to see you. Thank you so much. God bless you. Have an awesome evening.
Bye bye.